Okay, great. Okay.
Hello, everyone, and welcome to our ongoing Attract Capital webinar series. Today's webinar is entitled The Valuation Game, Innovative Strategies and Decisions that you can make to empower your own business. Today, I am here with Dave Barnett, CEO and owner of the firm Attract Capital. My name is Emma Franco, and we're going to go ahead and get started. So Dave, now, some people don't really understand valuation. So would you mind walking us through in your own words the basic rules of valuation?
Sure. I've spent about 25 years of my career on valuation, and it really breaks down to there's four basic elements to valuation. There's understand the company size is a very important determining factor. The EBITDA level and the EBITDA margin is equally important as the company size. But also the growth potential of the company is very important, and the type of buyer that you're targeting in the process is quite important. There's a big difference between whether you're targeting a financial buyer or a strategic buyer for your business. So it really comes down to where the company size and EBITDA level falls on the valuation spectrum.
Great, thank you, Dave. So expand a little bit more about valuation. As you know, valuation differs based on companies, large to small. So why do you think larger companies get bigger valuations?
Well, I mean, it's sort of a discriminatory thing in the marketplace, but larger companies do get bigger valuations, and it has to do with there's just more investors and there's a larger pool of lenders that are willing to invest in larger companies. There's a perception out there that larger companies, and I think the statistics bear it out, that larger companies are less risky, they have more fully formed management teams, they have better systems. And when you get hit with unexpected surprises, larger companies are generally, they've proven to be more stable over time. And also, when you look at the deal industry, when you look at private equity shops, when you look at lenders, most of them are set up to do bigger deals because it's quite expensive. There's a lot of transaction costs that are involved in the deal. So you typically, in order to be able to afford all the transaction expenses that are involved in the deal, it has to be a certain size. So it has to do with a lot of different factors. But I think that there's a lot, the good news for most middle market companies today is that there's a lot of money that is flowing through the middle market, and it's sort of equalized it a bit. You're still going to get a bigger price and a bigger EBITDA multiple if you're larger and you're a high EBITDA margin company, but it's not quite the disparity it used to be 5-10 years ago.
So let's talk a little bit about the reliability in the measurement of valuations. Do you think accounting-based valuations are reliable, or are they not?
So what Emma was just asking is how reliable I think accounting-based valuations are. And I've seen hundreds of these accounting-based valuations, and I must say that it's sort of a mixed bag. They tend to be very theoretical, and they tend to be very formula-based. They value a company based on its net present value, and they also value a company based on industry comparables. But valuation, from my background, is as much an art as it is a science. And it's not always a theoretical exercise. It very much is in the eye of the beholder. If the company really wants that target to buy because they have great products, because they have distribution channels, because they have interesting intellectual property, then that acquirer is going to pay a pretty big price for it. So it really depends. It's as much an art as it is a science. And I also find, Emma, that accounting reports really don't capture the synergistic benefits that an acquirer might get out of an acquisition, such as cost savings or revenue cross-sell opportunities, or just the ability to offer a wider suite of products and to more fully leverage the existing customer base. So the answer is I think it's a good place to start, but you certainly need to get a little bit more deeper into real-world understanding of valuation in order to get to the finish line on it.
Great, thank you. So now, in this art and science that you said valuation is, what do you think are the most common mistakes that people make?
Well, everybody thinks their business is worth about twice what it really is, and most buyers think a business is worth about 50% of what a seller wants. So there's sort of a disconnect, which is something that, as an M&A professional, you really have to work hard to bridge. I'd say a lot of the mistakes are rookie mistakes, in that people are not researching the important things to a buyer of a business. They don't understand what a buyer is looking at. They think they're just their business is great. They think that people are just going to accept it for what it is, but they don't bother to research what I would call value drivers before they start the process. Now, what is a value driver? A value driver is, it could be a customer, a set of customers. It could be products. It could be expansion into other markets. It could be any number of things that will increase revenue and increase profitability. Um, and I think another one, Emma, that's really important is a lot of businesses don't understand how to financially present their company. So they're going to print out their QuickBooks and they're going to say, I made $10 million in revenue and I made $2 million in EBITDA, so I should get a multiple of 8 times. And it really doesn't work that way. You need to understand the presentation conventions that an acquirer will look at when buying your company. And you really need to, in order to understand the presentation conventions, you really have to do your homework on the type of buyer that you think would be most appropriate for your business. Because if they're a larger company, they're going to look at it perhaps without any overhead included. If they're a smaller company, they're going to need to include some of the overhead. So it's highly case specific, and you really have to do your homework.
Thank you. So now moving forward, after, what do you think is your main takeaway from either the research and these key value drivers of the presentation is the main takeaway for smaller companies looking to get the most maximum valuation in an exit?
Well, I think it comes down to they really have to have clean numbers that are presented very well. And many people just don't focus on having clean numbers and presenting them well enough. But you really want to have an audited financial statement. You want to have good monthly financials. You want to have good quarterly financials. You also need to show that the business is not dependent upon one individual or a few individuals. You need to show that there's momentum and that there's viability to the business once you exit the company. And I think most importantly, you need to have a compelling growth story. Investors and acquirers pay large multiples when they think that there's an outstanding growth story. For example, we sold a business and we were able to get our client about 10 times EBITDA. And the way we were able to get 10 times EBITDA is we were able to show that this company had just developed a new line of products that had great potential. It was a huge addressable market, but they had yet to really sell them, but they were on the cusp of doing it. So there was going to be really strong growth ahead. We were able to establish that story as part of the sales process. And the acquirer really took it to heart and believed it. And hence we were able to get a very large valuation for it. So it really comes down to the numbers. It comes down to not being dependent on a few individuals. You have to have a strong and compelling growth story.
How important would you say a good comprehensive process is in evaluation?
I think Emma's question is how important is a good and comprehensive process. I think a comprehensive process is absolutely essential to maximizing value. It's a contact game. You have to contact a lot of people in order to have some qualified leads, and you really need to do your homework on whether you're going to go to the strategic market, whether you're going to go to the financial market, whether you're going to tap simultaneously. When we get involved in this for our clients, or when our clients are doing it themselves and we're advising them, we're really trying to focus them on they need to have a large universe of people that they're looking at, and they need to really be objective about the business on the front end and understand where an acquirer may look at the company and see some weak spots. Not every company is perfect. Every company has a weak spot, and you need to understand those weak spots before you go into the process, so you can proactively market against those weak spots.
In the same vein of contacting, could you give us some examples of companies that you've recently worked with on the valuation side?
Well, I work with a lot of companies that are buying companies, and so there's usually a sell-side advisor involved, but we're also involved with some of our clients in helping them get higher valuations. And what I would say is that what we do is we look at the P&L and we help separate the different expense line items in the P&L between this is an ongoing expense, this is a one-time expense, and we really apply a pro forma framework to it. And when you apply a pro forma framework to it, you're able to look at a company that has a certain level of actual EBITDA and present it with a much higher level of projected EBITDA, which an acquirer really wants to see. So a lot of times we're looking at a company, and let's say they had $5 million worth of operating expenses. We're able to present their their ongoing level of operating expenses at a much lower level, which increases your EBITDA. So it's really important to do it that way. And I think when you do that, you're able to get an acquirer to see, feel, and taste the profitability such that they really, instead of looking at the actuals, they look at the pro forma. You help them visualize it more easily with that sort of pro forma analysis.
Moving on, what industries do you think are really hot right now for strong, right now for valuation?
Well, I see healthcare as being really strong right now. I see a lot of healthcare companies in the market. The demographic story for healthcare is a very strong one. There's some changes going on, but there's always consolidation and fragmentation going on at the same time in healthcare. I see technologies being strong. The cloud has really created an opportunity for a lot of technology companies to offer suites of managed services and hosting services. So we see a lot of hosting companies, we see a lot of managed services companies, and we see a lot of specialty IT providers. We also see, generally speaking, business services firms that are doing quite well. So I'd say healthcare, IT, business services firms. I think on the domestic side, middle market companies that have good, strong business development processes that know how to find new customers, they're doing well, and their top lines are growing.
Finally, for our audience listening live, in your history, what are some of the valuation ranges that you generally see and work with?
Sure. So there might be some valuation professionals that are in our webinar audience, and it really runs the gamut. We see some companies where they have a really unique product that could be taken nationally. Those companies go for over 10 times EBITDA. We have a client right now that is discussing a 12 times EBITDA valuation, and they worked hard to get it, and they have a product line that is best in breed. For companies that don't have best in breed products, that might be more distributors, regional manufacturers, regional service providers. I'd say for companies that are from the $5 to $15 million revenue level, I see them around the 4 to 5 to 6 times EBITDA, so 4 to 6 times. I see companies 20 to 50 million that are closer to 5 to 7 or 5 to 8 times EBITDA multiple, and then really anything above 30 million in revenue that where you get from an EBITDA standpoint, let's say 5 million up to 10 million, it can go all the way up to 8, 9, 10 times EBITDA. So it really comes down to the revenue size and the EBITDA size. But we're seeing a lot of specificity, meaning the valuation multiples are more appropriate for the growth story and the EBITDA levels of the companies.
Great, Dave. Thank you very much. Now we're going to open it up to maybe some questions if anyone has any that would like to write out into the comment box. Please feel free to do so, and we'll be happy to answer them.
I think we have a question from somebody, and I'm trying to read it right here, which is how does bank financing figure into valuation and just sort of the credit conditions? That's a really good question. The credit markets are a huge driver to valuation, and it has probably a little less to do with the interest rates that banks are charging and has more to do with their aggressiveness in lending. Because when banks are looking to put more loans out, it really makes it a lot easier for a buyer to pay a higher price. So right now, I'd say we're at an interesting point in the credit cycle. I think banks have been much more conservative this time around than they were back in the 07-08 time period, which was sort of the buildup to the financial crisis. I think the regulators have done a good job restraining them. The banks have really focused more on asset-based lending. So while there is cash flow lending available, the multiples have been a bit more restrained than they were during the last credit cycle. But it does have a big impact, and we see that as something that the bank lending market is stable. So I think that's good for overall M&A valuation. And we have another question about how the macroeconomic forces affect valuation. And I think that's another really great question. And I think the macroeconomic forces are really determine the animal spirits, sort of the level of enthusiasm that buyers of companies have to participate in acquisitions. So when we have doom and gloom on the economy, we have slow growth in the economy, people have less conviction, and they're not willing to even get involved in it because they don't believe that they can grow their businesses that much. But we've had about, I want to say, 4 or 5 years of moderate to, if not restrained growth. And I think people feel that there's a level of conviction out there and that we're not falling off a cliff. Although earlier this year was a little shaky in terms of some of the things that are coming out of the Chinese market. But I think by and large, the macroeconomic picture is pretty strong. And the good news is that middle market companies really don't have as much, they're not as tied into the macro economy that some of the larger cap Fortune 500 companies would be. So they're somewhat insulated. And are there any other questions? Well, I want to thank everybody for tuning in today. This is our 4th webinar. We're going to have another one in a few weeks. Jack, thank you. Everybody else on the line, thank you. And we will be sending you an email with a copy to this link. We thank you for your support of Attract Capital. If you have any questions on valuation, or if you'd like to have a conversation with us in general about any of the financing needs that your clients or that you might have as a business owner, feel free to email me at dbarnett@attractcapital.com.
Thank you, everyone.